So you've been rug pulled, or you've been caught up in this UST Luna debacle that's been going on over the last few weeks. It's definitely not a nice feeling, and for those that are caught up, I generally hope that you're taking care of your own mental well-being, because that's really important at these times. But there's definitely some other implications that flow on from these things, and one of them is tax. So today I'm going to talk to you about what happens if you get rug pulled from a tax implications point of view. Hello everyone, my name is Rooshock, and today I'm going to be talking about the tax implications of a rug pull, or a situation where you're holding a crypto and it pretty much drops down to no value, as we've seen with Luna and UST over the past few weeks. So I'm going to go through that as an example, go through what that means and what your options are. So my first point is always going to be careful. You don't want to get caught up in a scam that you could have avoided. But if something like this happens where it's out of your control, you've invested and it's already happened, you're probably going to face two main scenarios. The first scenario is going to be where you can dispose of the coin, and the second scenario is going to be where you can't dispose of it. And this could go for coins or NFTs. And then at the end, I'm going to go through the one thing that you want to avoid because it's going to cost you a lot of tax. Now, I did mention that I'm going to touch on the Luna example. So have a look at this. We've got a coin here that had a value of over $100 only a week or so ago. And it's now pretty much got no value. So you can see from the charts, it's just a dramatic drop off. People have lost thousands upon thousands of dollars in this coin. But what happens now? You're obviously sitting on, at the moment, an unrealized loss. So what that means is you haven't realized this. So from a tax purpose here in Australia, you can't claim that loss yet because it's not realized. So what are your options? Now it's going to depend. At the moment, some of the exchanges keep delisting this coin and then they relist it. So at the end of the day, until you've disposed of it, it's hard for you to justify that that loss has been realized. So the easiest situation is that if you can dispose of the coin and you go ahead and dispose of it, that will be the taxing event. And then clearly it'll be whatever you purchased it for, whatever you sold it for, and that's going to be your loss or gain. Obviously in this situation, it's going to be a large loss. So that's an easy way to do it, is because you know this date is when I disposed of it, therefore that's the taxing event. Now, if you're able to dispose of it and you haven't disposed of it because you're holding on thinking, oh, hopefully it goes up in value, you're not going to be able to write that off as a loss because you're still holding it. You haven't realized that loss. And that'll come into play when I talk about this situation later down the track. But pretty much if you've got the ability to dispose of it, you can't recognize that loss until it is disposed of. Now, what happens in the situation where, okay, it's delisted from the exchange you hold it on? What are your options then? Well, if you have the option to somehow take it out and move it to another exchange and dispose of it, obviously you can go down that route. Or you may have the ability to send the coin to a burn address, which means you get nothing in return, but the coin gets burnt, it goes to the burn address, and therefore you've disposed of it. It's left your ownership, and therefore you can class that as a taxing event. So having those options is obviously a first point of call. But say you're holding something, you're holding a coin, you're holding an NFT, and it purely just has no value. You've paid money for it and it has no value for it. There's no market for it. There's no demand for it. It's just got no value. What are your options then? Well, it does get a little bit trickier because how can you justify and say that that's the disposal event if there is no disposal event? So if you're going to write this off and claim it as a disposal for zero, you're going to want to have some good documentation of why that was the case if you were getting an audit. So it may be that, look, it's been delisted from all exchanges. There's no way that I can access the coin anymore. There's no way that I can actually dispose of it. There's no market for it. There's no liquidity in it, for instance, or you're holding an NFT and it's just worth nothing. There's no way you can dispose of it. Nothing's ever sold on OpenSea, for instance. Having this documentation and these notes could help you in audit. It's not guaranteed, but at least you've got justification for why you've made that decision to write that off for zero value at that time. So why would you want to write it off, or why would you want to dispose of it? Well, that's recognizing that that's a disposal event. And for instance, if you bought Luna and you spent $1,000 on it and now you've disposed of it for not even 1 cent, well, you know that's going to be a capital loss of $1,000, for instance. We'll keep it nice and simple. And the great thing is that capital loss can offset other capital gains you've got. Now, the key there, and I've talked about multiple times on the channel, capital losses here in Australia can only offset against capital gains. Now, these capital gains can be from any asset class. It doesn't have to be just crypto, but you can't offset a capital loss against other income, such as employment income. So this means even though you may have invested in a range of cryptos this year and you've lost money on all of them, those losses may not be able to offset anything if you don't have other capital gains. So that is something to be aware of. If you've got $10,000 in capital losses and nothing to offset against, You can't offset this against your employment income, but you can roll these capital losses forward to future years and offset them against hopeful future capital gains. Now, I did mention there is one situation you really want to avoid, and that is where you're in a position where you've got a large amount of realized gains. So these may be gains you've made throughout the year. So say we're sitting in May now, in July through to April, you've made $50,000 of gains, and you've realized them, you've sold those, you've traded those crypto to crypto. So at the moment, you've got a $50,000 capital gain there, and that is going to be taxable. Now we get this situation. Say you've moved all of those into Luna and it's now worth nothing. So really, in essence, you may now have no gains, no losses. You may have come out square, but the key thing, you've got $50,000 of realized gains and $50,000 of unrealized losses. So if you do nothing and you just hold it thinking, oh, hopefully it will bounce back, come 30th of June, if you're still holding those unrealized losses, you're going to have to report a $50,000 taxable capital gain on your tax return, and you won't be able to utilize those losses. Now, if you go and sell them on 1st of July, you're going to have $50,000 of capital losses in the next financial year, but they don't help you for this current year. And you may have gone, okay, I'm getting out of crypto, it was too risky, I don't want to touch it again. So you may have these capital losses that you never utilize in the future. So understanding if you're sitting on a large capital loss and you've got existing capital gains, you need to have an understanding of, well, how is that going to impact me tax-wise? And is that going to play in your thought pattern when you make the decision on should you dispose of the asset or not? Now, obviously, more goes into any kind of investment decision. You need to do your own research, make your own decisions, but the tax implications are definitely something you should factor when you're deciding whether you're going to buy and sell an asset. It definitely should come into play because it's going to impact your overall financial position. So the key to avoiding this is to being on top of your crypto holdings, understanding what your realized gains are, understand what your unrealized gains or losses are, and therefore you can make decisions, especially at this time of the year. So I do offer tax planning sessions through my business or my NFT project, Rooshock. So if you haven't checked any of those out, go and do that. Or if you're struggling with reconciling your crypto tax nightmare, get in touch with us and we can give you a quote. I appreciate you watching the video. Make sure you hit the like button, hit the subscribe button, and go and check out some of the other videos I've got on crypto tax topics. I'll talk to you again soon.